Welcome to Chapter 9 in Finance 101. This chapter, we're talking about risk management and the role of insurance. So you're going to hear a little bit about health insurance, auto, car, well, those are the same things, homeowners, life. So we're going to kind of go over all the different kinds of insurance that you may come across in your life, and we'll explain why it's valuable for you to at least understand these and possibly get some of them depending on your situation. So, why do you need insurance? Plain and simple, your biggest asset, regardless of who you are, is your ability to make money in the future. What insurance does is it helps pass the risk that something happens to you off to someone else, so that in case something does happen to you, your family or loved ones would be covered. Human capital is your ability and willingness to work, learn, and earn. It's your most valuable asset. That's what we're protecting with insurance. So when we look at what impacts your health, most of this is going to be between your behavior and your genetic disposition. The other portion of it, which looks to be about 30%, is social, medical care, and the environment you live within. But you control a lot of your health, along with your genetics control some of that health as well. So when you're looking at risk overall, you have low, medium, high risk. And when you're looking at what could possibly go wrong, you have to kind of compare everything in life that's happening at any point in time. Now, we as individuals don't understand all the different risk. We understand there is risk, but you can't comprehend all the different things that could happen to you. It's where an insurance company comes in. They help you transfer the risk from yourself to another party. They charge different items, which we're going to talk about here, in order to make money to help mitigate that risk. So insurance company, basically a bunch of people pool their money together to mitigate their risk. And then when someone needs it, the group pays for it instead of just that one individual. So when you have insurance, you pay a premium. This is the amount that it costs you to get said insurance. This could be for health insurance, could be taken out of your paycheck. Auto and home insurance, you may be paying that through an escrow account or on a monthly or yearly basis. A deductible is the amount of money you have to pay in order for the insurance to come in when you are filing a claim. So if my house caught fire, which you guys have heard it has in the past, I had to pay $1,000 deductible before any insurance would come in. So I was responsible for that first $1,000. They were responsible for the other $130,000 that went with it. A copayment is a cost-sharing amount with the insurance company. Now I know some people are getting confused between a copayment and coinsurance. Copayment is a set amount that happens when an event occurs. So for instance, my windshield on my car breaks, get a crack. I have a $25 copayment to go get that repaired. Could cost $700, but my guaranteed is $25. Coinsurance, on the other hand, would be you pay 20% of what is the remaining balance. So if it's $700, I'd pay $140 through a coinsurance model. So copayment and coinsurance are not the same. Coinsurance is percentage, copayment is a set amount. So what do insurance companies do? They specialize home, auto, health, life, and they operate under these general guidelines. They help to minimize risk. They pool risk together with thousands of people. And then the higher the risk that of stuff occurs, the higher the premiums will be. So basically, they're hedging their bets when they do their premiums. And there's some extremely complicated algorithms and math that goes into how much somebody has to pay for a given insurance coverage. If you want to do that, you can become an actuary. And I've seen some actuaries in my day. They are very, very smart people that have to do a lot of math. So a visual of kind of what I was explaining. People start paying their premiums. They go to the insurance company. When someone needs it, the insurance company pays out that claim. So health insurance, I will tell you, out of probably your professors that you will have, I probably deal with health insurance on a more regular basis than most. My wife, we've gone through a few years where we've had multiple surgeries, different things related to our newborn that's coming. I kind of monitor my health insurance to an extreme. So if you do have questions about it, I cannot give you personal advice, but I can give you directions of things to be aware of. So just shoot me an email. But health insurance is a financial tool that helps people predict or helps cover people from possible medical issues. Healthcare, to be honest, is one of the most significant monthly costs for most households. That's under your housing, transportation, and taxes. Health insurance is there. When I was paying for my other plan, it was $300 a month that I was paying for health insurance. Now it's about $70 with the plan that I selected. So it depends on your exact plan, what coverage you choose. If you have a choice, if you go through the marketplace or if you go through your employer, a lot of things go into what makes up health insurance. So I will side with this, that these are pretty accurate numbers. My wife just got done having a baby, so I've been in the hospital or with her. I've been in the ER, been to a doctor's, and I've been getting her meds. I just showed her this morning our health. It's now March 30th when I'm recording this video. As of this morning, we've had over $158,000 of healthcare cost, and it is March 30th, so we're not even done with 3 months yet. With insurance, I'm going to end up paying about $7,000 of that, and most of that's going to be through my health savings account, which I'll explain later on. Hospital stays, really expensive. The wife having a baby was $94,000 they billed us for that hospital stay. Second time we went in was $30,000 that we got billed. Pretty big amounts there. ER, we've gone to the ER a few times. Usually it's about $2,000 to $3,000 for an ER visit, so that's an accurate number. Doctor's office visits, depending on which doctor you go to, ours is typically $87. Now that our deductible and coinsurance is hit, it's going to be free, but typically it's between $80 to $150 depending on your doctor. Prescription drugs, it depends on your insurance plan. Our highest go up to $30, $75 if you were getting some specialty meds, but most will range between $12 and $0 depending on the medication. So when you have insurance, there's different costs that go with it. What you pay for insurance is your premium. This can be a combination of being paid by yourself or your employer or both. A deductible is what you have to pay before your insurance kicks in. So it's the base amount you're going to have to pay out of pocket before any insurance actually goes into play. Coinsurance is what happens after you hit your deductible, so you pay that initial amount, then you pay a percentage basis between what the hospital or medical facility charges and what you and your insurance pay. Typically, this is an 80-20 split. The health insurance company will pay 80% of those costs, and you will be stuck with 20% until you reach your out-of-pocket. Now, a copayment is slightly different. This is a flat fee that it has to be paid when a service is provided. Depending on your service provider or health insurance company, some of these are with doctor's appointments. When I was little, we'd have to pay $25 per doctor's appointment. Regardless of what occurred at that appointment, we paid $25 when we left. My insurance now, they bill everything, so I play through the deductible coinsurance rate. Just depends on your plan. Most health insurances, actually all of them, have what's called an out-of-pocket max. If you ever wanted to know if you got in a bad traffic accident, had a baby, had a stroke, heart attack, whatever, what you would pay for in your health insurance, we'll take a look at your out-of-pocket max. My out-of-pocket max for my family is $8,000. That is the most I will pay in a given year, aka this year, for health insurance. Now, when that happens, you start with deductible. That's going to come out first. Then I pay 20% of the rest of the bills to get up to that $8,000 mark. Now, once I'm above that, the out-of-pocket max, the health insurance company pays for everything as long as I'm within the network of providers that they have. So I know at this point in time, at March 30th, I will not pay any more medical bills than what have already been billed to me for the rest of the year. So I can go get any surgery, anything done that I could imagine or want, and it would be covered because I've hit my out-of-pocket max for the year. There's different kinds of health insurance. So there's a preferred provider organization. This is a fee-for-service plan. This is the most flexible, but it's the most costly insurance. It allows you to use services at different hospitals without permission, or clinics, doctors. And it also has reduced deductibles, copayment, and coinsurance if you're within the network. So you'll see a lot of these from your healthcare providers. So you see this, and you also see managed care. I don't see this as much as we used to see it, but the HMO is a health maintenance organization, and it basically tells you can go to certain doctors within a certain geographical region. We have smaller copayments, and we try to prevent illnesses rather than treat them, or kind of do the preventative maintenance side. So there's hybrid plans. These are kind of a mix between pay for service and the managed plans, and they're POS plans. I have not seen one of these for a while, but basically if you go outside a network, you have to get prior permission. So you kind of go into your care doctor that's in network, they give you permission outside a network. Your insurance company gives you the green light. Once you get that green light, you're able to go to that provider and get those services done. The most popular plan is a high deductible plan. This is what I currently have. I used to have a PPO plan. Now I have the HSA plan, or the HDAP in this situation. Usually premiums are a lot lower, but your out-of-pocket expenses are going to be a lot higher. My deductible for my family was $5,500. It's a pretty high deductible for that. My out-of-pocket would be $8,000. So it's really high compared to my old deductible, which was $1,300, and my old out-of-pocket, which was $39,000 or $3,900. You can go onto the healthcare marketplace if you would like, and your employer does not provide health insurance, and there's different levels of coverage. Catastrophic is going to be for those who just want, if I get in a car wreck, I want insurance, want to pay low premiums. Platinum is going to be high premiums, really top-end insurance. Bronze, silver, and gold are going to be a mix in between there. HSAs. If you have a high deductible plan, you can open what's called a health savings account. This allows you to pay for health expenses tax-free. So basically, money goes in before taxes are taken out of it. You can use that for approved medical expenses, dental, vision, and some other items you can pick up from the store. If the money remains in the account, it can also grow depending on the investments you select. Those growths are non-taxable as well, and you can use those for those same health items. You can pay deductibles, copays, and prescriptions. And once you have it, it does not expire from year to year. This is a little different than the FSAs that we'll talk about. Those expire each year, but the HSAs are allowed to roll over from year to year, so you can always go and use those if it is needed. FSA, these are flexible spending accounts, and it's this kind of like an HSA, but if you do not have a high deductible plan, you qualify for an FSA. Now, the FSA under the high or the lower deductible plans, the problem is if you don't use it, you lose it within the year, and there's a lower amount that you can put in there tax-free. Now, they can be used for the kind of the same items, such as prescriptions, eye doctors visits, deductibles, copays, but you're usually limited between $2,700 to $2,800 depending on exactly what that is. So, what do I recommend doing here? If you have an HSA, drop your money into it because it's going to grow tax-free. If you have an FSA, only put as much as you need in there. You don't want to waste money just to save a little bit on the back end. HSA, load it up as much as you can. Usually employers will provide a match. So like Ball State, for instance, if I put in X amount, they give me so much a month that they'll put into my HSA. Always take the free money. If you know you have upcoming medical expenses, such as like a baby, like we did, you may want to up your contribution so that you can cover those expenses. That's exactly what my wife and I did. We switched to a high deductible plan, saved money on the premiums, pushed a bunch of that money into an HSA account, got the match that Ball State provided, and was able to actually save $4,000 on having the baby because of the way we manipulated the health insurance. When I say manipulation, it's not technically a bad thing. It's just you know how to use the system to when you have those medical expenses. Disability insurance. Disability is defined by the Social Security Administration, and it's when you cannot do the work you did before an accident or illness, you cannot readjust your skills because of your medical condition, and your disability is going to last at least a year or until death. Here's some charts if you want to know your disability probabilities. Young, not so much. As you get older, it goes up a little bit. So, kind of makes sense. If you have a disability, it could impact your progress towards a financial goal. They give you some stats on this. You don't need to memorize those. There's two types of disability insurance. So there's short-term disability and long-term disability. It depends on how your employer is set up. Some will mandate that you buy certain insurances. Some will tell you that you don't need it. Some will give you the option to buy it yourself. It really is an option you need to select for your own personal thing. I take both of these insurances because I know my family has a history of strokes. If I had a stroke, I would want to have insurance to cover if I was not able to go back to my job immediately. I'm a little different than most of you. Some of you won't need to take these insurances. You may want to save the extra funds. If it's $4 or $5 a month, get the insurance. Always be willing to pay that little bit for the coverage and the help that could be there, because you never know if you're going to need that or not. If it's a lot of money, then make an educated decision. Those small amounts, you might as well just do it. They'll go through their cost of how you make premiums. Kind of makes sense. If you work a heavy job, you're going to pay more. If you do things that make you sicker, you're going to pay more. If you are smoking around toxic chemicals, yeah, you're probably going to die. Workers' comp. This is when you become ill or injured because of work. This benefits you when you're doing something that's part of your job. Disability insurance is regardless of how the disability occurred. Okay. Workers' comp's usually covered. Disability insurance, you typically have to pay for this, or your company will supply it for you. Life insurance, do you really need it? Yes. Here's when you need it. When you start having somebody that you care about or that relies on you financially. So your first little bit, you should ask yourself three different questions. Number one, do you have underlying health conditions that are in your family history that may make you uninsurable in the future? If that is a yes, then you need to get either a 30-year long-term or 30-year term policy, or consider whole life insurance as soon as possible. If you do not have that family history and you're relatively healthy, you may want to wait until you have the opportunity to buy it when you start having a significant other. That's kind of your first bit that you go, oh, okay. Second bit is when you start taking on large quantities of debt, such as a house or other debts, such as student loans. You may want to be able to pay those if someone else would be held responsible for those. It's kind of number two. Number three is, do you expect to have a child? If you expect to have a child, you may need to change your life insurance plans accordingly. And then finally is, once those are all said and done, what would you need to provide for a family if you were gone tomorrow? That's the question you have to ask. Life insurance, there's a policy owner. This is the one who makes the policy payments. The insured is the one who must die. And the beneficiary, that fancy word, is who gets money once that person that is insured passes away. Two types of life insurance that we're going to talk about. First one is term. This provides insurance for a predetermined length of time. If you die, you get that amount. Obviously, you don't. Your beneficiary does. But say you have a 30-year policy, you're covered for 30 years. If you die 30 years in a day, they won't get any money past that. These types of policies tend to be lower cost, and I highly recommend these. Whole life tends to be a savings vehicle for those who can't save, those who have different issues. I would recommend term life policies and then building up your Roth IRA to help self-insure yourself. Personal recommendation. I know that people will change and have different views on this depending on your financial and health situations. As you get older, cost of this gets higher. Obviously, the older you get, more likely you are to die because you have less years. Cash value, also known as a whole life. Basically what you do is your cash value grows, you put money in it, you're guaranteed to have this as long as you are paying your premiums, you'll have the coverage. It can grow, and you can always cash out money later on from the policy. There are typically fees in there, and it is usually way more expensive to have this kind of coverage. For example, I have a whole life policy and a few term life policies. My whole life policy, for $100,000, is 3 times more expensive than the insurance for $300,000 that I have on my term life policies offered through my employer. Big difference. Whole life, it's never going to go away. The term, it could, if once my term expires. I mentioned that there's whole life. That's your most common one. You will see universal, variable, and variable universal. If you're going to do this, I recommend that you go whole life or universal life insurance. It's completely up to you. Something to note. Insurance agents who sell you term or whole life policies do have a financial incentive to do so. Whole life policies earn a greater commission than term life policies. So if you're going to go in the market for whole or universal life, please know that, do your research, and don't get pushed that way. Most people are just fine with term life policies. Whole life is great if you want that kind of added protection and investment aspect. Looking back, I'm very glad I did what I did, but I would have recommended my younger self to get multiple term life policies and invested the difference into a Roth IRA to help self-insure myself. How much life insurance do you need? You can calculate it in many different ways. There's a bunch of online calculators. Go see those. Figure out what you want to do. There is no right answer here. I could give you a number, but it's completely reliant on what debts you have, what you want to leave for people, how valuable you think you are, what's your current income, what you think your income is going to be, how many kids, what you hope to play. There's a lot of questions that go into that. Auto insurance. So, what you have is personal automobile policy. This provides coverage in case of an accident. This policy, which most of you will have if you have cars, provides medical and property damage for others that you harm and repair cost to your vehicle if the policy extends beyond just the liability aspect. So when we're looking at this, your typical liability coverage is required for you to drive. Most of you, your parents are probably paying it. You may be paying your parents. You may be on your own. But you're going to see some weird numbers when you look at this. It's all going to be about the amount the insurance company will pay per accident. So the 25, 50, and 10. $25,000 will pay medical expenses for someone other than yourself if you cause this accident per person. $50,000 is the max they'll cover for the entire accident of those same costs. And the last one is how much $10,000 the company will pay to repair someone else's property that you damage. You're going to hear when you shop for insurance these terms all around. Just know that this policy is meant for what you could harm to others for. Because in an accident, if someone else causes the accident, they're responsible and their insurance will cover it. What you are insuring is if you cause an accident or harm to someone else. If expenses from that go above and beyond what the insurance covers, you are fiscally responsible for those costs. Some people like to have a lot of insurance just in case something happens. Others will take the premium cut and kind of gamble with it. I recommend getting enough that if an accident occurred, you're not going to be shit out of luck, but not too much that you're playing it like you're wearing pillow fort around all the time so that nothing bad happens. Your insurance agent can kind of point you in the right direction of that. How to find an insurance agent. Go to someone you know and trust. If you need advice, send me an email. I will pass you along to a few insurance agents that I know, that I have worked with for years, that I personally know and like, but it's all up to you. Ask your parents and friends for examples as well. So some ideas, this would be a good test question of things that impact your premiums. You can see what shoots it up, what shoots it down. Pretty much the more behaviors you do that could pose a risk, the higher the premiums. The things that you can show that mitigate a risk, lower premiums. Now, there's two other kinds of insurance that you can pick up. You have collision and comprehensive. So, collision repairs pays for your car repairs. And comprehensive is stuff that is not caused by an accident, such as hailstorms, broken windows, and vandalism. If you purchase a new car or you lease a car, you're going to be required to have these by the financial provider that you're paying on the loan. Are these worth it? It depends on your car, your area you live in, your driving record, and kind of what you can afford if something occurs. I have collision and comprehensive on all three of my cars at this point in time. As my Elantra gets older and not worth as much, I will probably drop collision and comprehensive off at a point. When my cars still have a high value, I want to ensure that that value sticks around. Two other kinds of coverages that you could purchase: uninsured motorist and gap coverage. A lot of times these are compiled all into one policy, but you will see different terms used. Uninsured motorist is insuring yourself in case that a motorist that hits you, causes an accident, has no insurance. Your insurance can then cover it for you. So you have to have this for that to be the case. Gap coverage is what you pay to account for the difference in the price of your car to what the actual value of that car is. So sometimes when you get a total car, they'll only pay the current market value, not what you owe on that car. Gap insurance covers the difference. When you buy a new car or you lease a car, gap coverage is something you need. Used cars, not really. You can print this out and put this in your glove box for all your cars. What do you do when you have a car accident? I have been in 2-3 accidents. Somebody rear-ended me when I was on a state highway when I stopped for an ambulance. One time I hit someone going 3 miles an hour in a car, and I put a small dent in the back of their car while I was pulling off of the highway. So obviously nothing too crazy, but here's what you do. You stop the car immediately. Do not flee the scene. If someone's injured, call 911. If there is major damage, please still call 911 to report the incident and get a police officer to come out and to file a police report. You exchange information with the other driver and stay calm and focused. Do not take blame. Do not volunteer information. Do not sign anything. The only thing you would need to sign is if a law enforcement officer had you do it. Other than that, exchange information and call your insurance company immediately for the procedure they want you to follow. Now, when it comes to homeowners and renters insurance, we're looking at perils, hazards, and other terminology that goes in here. So a peril is anything that causes you to experience a loss. A hazard is a situation that increases the probability of that peril to occur. So for instance, hurricanes are a peril. Indiana, my likelihood of a hurricane impacting my life, not high. If I was down in Florida, I have a hazard of a hurricane because I am closer to where these things occur, thus increasing my likelihood that this happens. We go back to the random car incident one that we talked about earlier. But when you have a homeowner's policy, you typically are covered for 6 different things. Number 1, your personal property and the house itself. Then you have the structures on the property, so it'd be sheds, garages, carports, anything else that are outside the actual physical building. You have personal property for replacement, loss of use payments, liability coverage, and medical payments for those injured who are not yourself. So we're going to go through some of these here. Okay, so first of all, let's talk house fire. When I had a house fire, we had structure, or let's go back a little bit. Let's talk homeowners insurance in general. I've used my homeowners insurance twice now. First time, we had hail damage to the roof. That would be for my dwelling and personal property. I also had hail damage to a siding, to a gazebo I had in the back, plus a shed. That fell under the replacement for structures on the property. So I got a new roof. I had to pay my deductible, but got a new roof for the house and the shed along with the gazebo and some siding replaced on the house. Then I had a house fire. When that happened, they had to replace different items within the house. Actually, I sit in a room where they had to replace the carpet in and repaint because of the house fire. They started replacing anything that was outside of the house. they didn't have a lot of structure damage with that, but if there would have been, that would have been included in there. All of my clothes, bed, end tables, dresser, a lot of stuff got damaged in the fire. That would have been my personal property. Loss of use. If I was using my house as a business, I'd have to get a different policy, of course, but if I was using that, I would lose out on the money that could possibly be there. Liability coverage would be, oh, I had an incident and I am now liable. My house is an asset. Insurance sometimes will pay for that so you don't lose the house. And medical payment would be, I have someone over, they slip and fall and break their neck on the ice. Because I didn't salt it properly, I would be liable for that. I'd have to pay for the medical payments, and my homeowner's policy could do that. Another instance of liability coverage would be like I hit a golf ball and break a window. I could use my homeowner's policy to cover my liability for that. So, inventory everything you own. My one piece of advice, get a video camera, walk around your house. If it's your phone, take a video of everything in your apartment, your house, once a year. You do this because in the instance that there is a house fire, a lot of things get destroyed and you have to inventory all of them. I had to put together an Excel spreadsheet with values of everything that was destroyed in my house fire. You talk about a pain in the butt. I had to price everything, remember what I bought, what I had paid for it. It's a lot of work. If I had a video of my area, I could have not missed certain things. I'm positive I missed a few things or just didn't want to go through the process of doing it. If you have that video, it's a lot easier for you to do that kind of stuff. If you have anything that's worth more than $2,500, you need to add a rider to your policy or a personal property floater to get extra coverage on that. If you think you need some additional liability coverage, you may hear the word umbrella policy tossed around. This usually covers you up to $1 million of liability. It's relatively inexpensive and kind of helps you just in case the worst of the worst happens. And then sometimes your homeowner's insurance does help cover identity theft. So to kind of get an idea of what an umbrella policy is, you have your different policies under here. It covers anything in addition to what those others didn't cover. So it's great if you had a big car accident and you had somebody that's had to go to the hospital for a year, you'd be liable for those expenses. Your insurance would only cover so much from your auto policy, then you would have liability coverage, but then if anything went above and beyond that, the umbrella policy would be there. It kind of keeps you extra safe for a relatively low amount of money. Renter's insurance. This is really important for those of you who rent, and I'm talking anybody who rents. When you rent, the property owner is responsible for the items that are, or the building itself, the walls. Any items that are in there that are your own personal property, you are actually liable for. For instance, I have a flood in the house. It tears up the carpet and some of the walls. I'm in my apartment, and it ruins my computer, my TV, my gaming system, and a bunch of textbooks I have laying around. The person who I am renting from would be responsible for fixing the repairs in that house, the floor, the walls, and any plumbing that went bad. They would not be liable for the items that were damaged. You would be liable for that. A lot of people think it would be the responsibility of the landlord. It is not. That's where renter's insurance comes in. It's relatively inexpensive, between $150 to $300. If you combine it with an auto policy, it's usually a lot cheaper. But it covers your items up to $25,000, and if that stuff does occur, you can simply file a claim and get money to reimburse yourself for the expenses of those damaged items. It's way too cheap not to consider getting renter's insurance, especially over the next 5 to 10 years as you rent a lot and you start building up your items and your belongings that become worth more and more. Last one we're going to talk about is long-term care insurance. You may deal with this in terms of your parents or grandparents going into a nursing home or long-term care facility. There are insurance policies that are out there. Basically, they pay into them, and when you go into an assisted living, the insurance policy covers for X amount of months or years. Now, the benefits of long-term care insurance. When you have somebody that goes into long-term care, sometimes you may need somebody at the house, you may need somebody at the skilled nursing facility. These may be nursing homes. It depends, but what these does is it pays for a portion of those costs so that your family or your estate does not have to bear that burden. Medicare and Medicaid, we've talked about these briefly. Medicare is for those over 65. It covers only limited long-term care expenses. And Medicaid is that comprehensive for those who are neediest in society. A person must have both limited income and assets, and Medicaid will pay for your long-term care services if you spend down your assets to the poverty level to qualify. Here's your kind of different areas of long-term care. You see doctors, nurses, businesses, home health aides. All this information is great for you to know that you can plan for your parents if they will have some sort of medical need for this, or you can prepare for yourself as you get older and your children may be the ones that are handling this situation. And that's the end of Chapter 9. Again, if you have questions, please shoot me an email at cawilkie@bsu.edu. If not, best of luck, and I hope I've answered most of your questions about insurance.